Imagine holding a credit card, right, where the bank actively expects you to default.
I mean, that is a really tough spot to be in.
It is. You're struggling with the cost of groceries, inflation is biting, you're stretching every single dollar, and you might just miss a payment.
Yeah.
Now imagine that very same bank, the one holding your debt, just reported its absolute best revenue in an entire decade.
It really feels like a paradox when you frame it that way.
It sounds totally contradictory.
It does. But that tension between corporate success and, everyday consumer struggle is actually a perfect reflection of the strange economic moment we're living in right now.
Welcome to today's deep dive. We're unpacking Citigroup's Q2 2026 earnings results presentation and press release, which just dropped on July 14, 2026.
And it is quite the report.
Oh, absolutely. But look, we are not just going to read you a dry financial report or walk you through some giant wall of spreadsheets.
No, nobody wants that.
Right. This is the story of a massive, sprawling global bank pulling off a stunning quarter. And we are going to look under the hood to see exactly how they did it.
Yeah, we're going to track where the money is actually flowing.
Exactly. And we'll explore what that flow tells us about the broader economy you and I live in every single day. By the end of this deep dive, you're going to understand the actual plumbing of global finance so much better.
Because looking behind the curtain of a bank of Citi's sheer size, it's incredibly revealing.
It really is.
I mean, when an institution with this much global footprint makes a move, it creates ripples that touch almost every sector of the world economy.
Okay, so before we start looking at the individual gears turning inside the bank, we need to grasp the sheer scale of the headline numbers they just dropped.
The numbers are massive.
Just to set the stage for you, in Q2 2026, Citi's total revenues hit $24.8 billion.
Wow.
Yeah, that is a 14% year-over-year increase. Their net income skyrocketed by 45% to $5.8 billion.
Which is just a huge leap.
Right. And earnings per share, or EPS, jumped 61% to $3.15.
Yeah, CEO Jane Fraser literally called it the best quarterly revenue in a decade.
Okay, let's unpack this. Because I keep picturing Citi as this massive, heavily loaded cargo ship that has been slowly, painfully trying to change direction for years now through all this massive restructuring.
That is a really good way to look at it, actually.
And this quarter feels like the exact moment the ship finally locked onto its new course, the captain hit the throttle, and the engines just roared to full speed.
The cargo ship analogy captures the momentum shift perfectly, I think, because turning an institution of this size, it takes immense operational discipline.
Right, it doesn't just happen overnight.
Exactly. If we connect this to the bigger picture, this revenue spike wasn't a one-off lucky break or, some clever accounting trick.
It was real growth.
Yeah, it was driven by double-digit growth in 4 out of Citi's 5 core interconnected businesses. They essentially fired on almost all cylinders simultaneously.
That's wild.
But the most vital number in this entire report isn't actually the total revenue. It's the return on tangible common equity, or ROTCE.
Okay, the ROTCE.
Right. It hit 13.0%, which is a jump of roughly 430 basis points year over year.
Wait, 430 basis points.
Okay.
Let me translate some of that banking jargon really quickly for the listener.
Sure, go ahead.
So we're talking about roughly a 4.3% jump, which is a massive leap for a bank of this size. And they blew past their 2026 target of 10 to 11% already.
They completely overshot their own goals, yeah.
So looking at this ROTCE number, to me, it feels like it's fundamentally measuring how much bang they are getting for their buck.
That's a good way to put it.
Like for every dollar of equity investors have entrusted to them, this metric shows how efficiently management is turning that specific dollar into profit. Am I reading that right, or is there more to the mechanics of it?
No, you've hit the nail on the head regarding efficiency. What the ROTCE proves is that the massive restructuring Citi has been undergoing is actually working on a structural level.
So the cargo ship is actually turning.
Yes. For years, critics argued that Citi was simply too big, too sprawling and too inefficient compared to its peers.
Right.
So hitting a 13% return on tangible common equity and surpassing their own targets so early, it sends a really clear signal to the market.
Which is what?
That they aren't just getting bigger by taking on more risk. They are getting structurally much better at manufacturing profit from their existing foundation.
Okay, here's where it gets really interesting. We know 4 out of 5 of those core businesses saw double-digit growth. Let's actually pit the most surprising driver of this revenue against the most glamorous ones to see how Citi's actually generating all this cash.
Let's do it.
Because in the financial world, investment banking and equities are, well, they're the flashy sports cars.
Absolutely.
We're talking IPOs, complex derivatives, high-stakes trading floors, and sure enough, the sports cars had a phenomenal quarter.
They really did. Equities revenues were up 45%.
45%.
Yeah, driven by derivatives and prime services, with prime balances up nearly 60%. And investment banking was up 44%.
And that was specifically powered by equity underwriting, jumping an incredible 92%, right?
Yeah.
And debt underwriting up 65%.
Right. Those are the massive, headline-grabbing numbers that make it to the front page of the financial papers.
Oh, for sure.
When equity underwriting almost doubles to 92%, it tells us that companies are going public or raising capital at just a furious pace.
Yeah, everyone wants it.
Exactly. The macroeconomic environment, whether it's market optimism or companies needing to refinance debt, it created a massive wave of deal-making. And Citi positioned itself right at the center to collect all those advisory and underwriting fees.
But then we look at the services division.
Ah, yes. Services.
If investment banking is a Ferrari, services is basically a reliable 18-wheeler.
That's a great comparison.
It's the division that just moves money across borders for corporations and holds custody of assets. I mean, on paper, it sounds incredibly boring.
It does sound a bit dry, yeah.
But the services division hit its highest ever quarterly revenue of $6.4 billion, which is up 18%. And it delivered a massive return, a ROTCE of over 30%.
It's staggering.
I mean, how is the boring 18-wheeler completely outracing the sports cars with a staggering 30% return?
Well, what's fascinating here is that we can trace that 30% return directly back to the essential plumbing of the global economy.
So plumbing.
Okay. Service is broken down into two main parts: Treasury and Trade Solutions and Security Services.
Okay.
Let's look at Security Services first. They reported that assets under custody and administration are up 22%.
Wait, assets under custody meaning like literally just holding and safeguarding the stocks, bonds, and cash for these giant institutions?
Yes, exactly. Providing the highly secure infrastructure to hold and administer trillions of dollars in assets.
Trillions.
Trillions.
Wow.
But the real powerhouse here is Treasury and Trade Solutions, where cross-border transaction value is up 13%.
Cross-border transactions, so moving money around the world.
Right. Imagine a massive multinational tech company. They need to pay thousands of vendors, process payroll in 50 different currencies, and manage cash flow across 30 different countries simultaneously.
Okay, yeah, that sounds like a logistical nightmare.
It is. And they rely deeply on Citi's Treasury and Trade Solutions to make that happen seamlessly.
Oh, I see where this is going. So once a multinational corporation wires its entire global payroll and vendor payment system into Citi's software.
Good luck leaving.
Right. Ripping that out would be like trying to change the engine of the 18-wheeler while it's driving down the highway at 70 miles an hour. They just don't leave.
That operational stickiness is exactly the secret sauce.
Stickiness, I like that.
Yeah. Once a corporation integrates their massive enterprise accounting systems with Citi's global network, the switching costs are astronomically high.
Which means guaranteed income for Citi.
Exactly. It creates incredibly reliable, high-margin revenue. Furthermore, unlike the investment banking Ferrari, this services division doesn't rely on the stock market having a good week to generate fees.
Oh, true. People still need to get paid, even if the S&P 500 is tanking?
Precisely. It processes transactions every single day, regardless of what the market is doing. And most importantly, it generates that massive 30% return because it doesn't tie up huge amounts of the bank's risky capital to provide that service.
Right, it's just software and networks.
It's fee-based, technology-driven income.
So Citi is basically embedding itself into the day-to-day operations of these massive global corporations.
Yes, they are.
But, managing money for a massive corporation naturally brings you into the orbit of the ultra-wealthy executives running them.
Oh, absolutely.
Is that why we're seeing such a massive spike in their wealth management division? Because from the massive corporate plumbing side of things, let's transition to how Citi is handling individual wealth.
The synergy between serving corporate behemoths and serving the people who run them is a very, very deliberate strategy.
Well, the numbers certainly back that up. Wealth revenues increased 13% this quarter, which marks their 9th straight quarter of growth.
9 straight quarters. That's consistency.
Yeah. They brought in roughly $16 billion in net new investment assets. And what really caught my eye is that almost 2/3 of that $16 billion came from just deepening relationships with existing clients.
Right, getting more wallet share from the people they already know.
Exactly. But at the same time, in a totally different section of the report down in the all other managed basis section, we see they completed the sale of a 22.6% equity stake in Banamex.
Yes, the Mexican retail bank.
Right, and that follows a 25% stake sale they did back in Q4 2025. So we have this consistent, massive growth in high net worth wealth management sitting right alongside the active shedding of legacy retail banking like Banamex.
Yeah, and connecting those two facts reveals the entire philosophy of Citi's current transformation.
How so?
Well, for a long time, the prevailing wisdom at Citi was to be a financial supermarket.
A one-stop shop.
Exactly. They tried to be everything to everyone. They wanted to be the local retail checking account for everyday people in a dozen different countries, while simultaneously managing billion-dollar corporate mergers in New York and London.
That sounds exhausting to manage.
It was incredibly bloated. So what we are seeing with the phased sale of Banamex is the deliberate dismantling of that old supermarket model.
Okay, making sense now.
Because operating consumer retail banks in foreign countries is incredibly expensive, is heavily regulated, and it ties up a massive amount of capital for relatively low returns.
So they're essentially trimming the fat of international retail banking to feed the muscle of global wealth management.
That is the exact strategic pivot. They were freeing up all that trapped capital from foreign retail operations and pointing the ship hard toward high-yield fee-based businesses.
Like wealth management.
Right. When you see $16 billion in new investment assets flowing in, and 2/3 of it from existing clients, it means their wealth advisors are successfully convincing ultra-rich clients to consolidate their portfolios at Citi. It's a story of intense focus. They want to serve multinational corporations and the ultra-wealthy, and they are totally willing to shed their legacy past to do it.
Which brings us to a really harsh reality check.
Yeah, the other side of the coin.
We've been talking about these booming corporate services, moving billions across borders, and incredibly wealthy clients handing over more of their portfolios. But what about the everyday person?
The everyday consumer.
Because here is where these high-flying corporate numbers violently collide with the reality of the consumer economy. We need to look at U.S. consumer cards, or USCC.
Yes.
U.S. consumer cards was the absolute only core business in this entire report without double-digit growth.
That really stands out.
Revenues were up just 1%. Meanwhile, expenses for that division were up 10%, driven by things like customer engagement, marketing, and severance.
This raises an important question, right? Because the consumer data in this report is the flashing warning light on the dashboard.
It is a massive red flag. The total bank provision for credit losses was $2.5 billion this quarter.
$2.5 billion.
And within the U.S. consumer cards division alone, net credit losses were a staggering $1.9 billion.
It's a huge hit.
Their 90-plus days past due metric is at 1.21%, and the net credit loss rate is sitting at 4.01%. So what does this all mean? Wait, 4% of their credit card debt is just gone, written off.
Yeah, unrecoverable.
Think about that for a second. In any normal business, losing 4% of your inventory to theft or spoilage overnight would trigger an absolute panic in the boardroom.
Oh, heads would roll.
Exactly. How is Wall Street not panicking? I have to challenge this optimistic decade-best quarter narrative. Are we seeing severe cracks in the everyday economy that this booming corporate side is just masking over?
The contrast you are highlighting is the exact tension economists look for in these granular reports.
So not just a fluke.
Not at all. What we're seeing in Citi's numbers is essentially a tale of two economies playing out on a single balance sheet.
Okay, break that down for me.
Well, the everyday consumer, the person swiping that credit card for gas and groceries, they are facing serious macroeconomic headwinds.
Right, inflation.
Elevated inflation, high interest rates, the general cost of living just stretching their paychecks. It is leading directly to significantly higher credit card defaults.
That makes total sense.
And that 4.01% net credit loss rate means a significant chunk of consumer debt is just unrecoverable, like you said. For a strictly consumer-focused regional bank, a 4% loss rate would absolutely trigger boardroom panic.
But Citi isn't panicking because they have the corporate Ferrari and the 18-wheeler printing money in the background.
Exactly. Not only are the corporate divisions firing on all cylinders to absorb that $1.9 billion consumer hit, But Citi has also built a fortress balance sheet specifically to weather this storm.
A fortress balance sheet.
Yeah. They are currently sitting on over $22.2 billion in total bank reserve.
Wait, meaning they literally have over $22 billion safely tucked away just in case those credit card users can't pay them back.
Yes. That reserve acts as a massive shock absorber. The corporate wins in services and investment banking are so disproportionately large that they completely mask the consumer pain at the headline earnings level.
Wow, that is wild.
But if we dig into the data, the narrative is undeniable. The global corporation is thriving and highly liquid, while the everyday credit card user is financially stretched to their absolute limits.
Okay, so with the bank successfully using its global corporate profits to shield itself from consumer losses and still managing to make billions, where is all this extra cash actually going?
That's the billion-dollar question.
Well, if you are a shareholder listening to this, it's going straight into your portfolio. Let's look at the windfall. Citi returned roughly $5.0 billion to common shareholders in Q2 alone.
In just one quarter.
Yes, that brings their total for the first half of 2026 to $12.4 billion. And they just launched a massive $30 billion common share repurchase program.
A $30 billion buyback.
Yeah. For anyone listening, the mechanics of a buyback are pretty simple but incredibly powerful. By taking $30 billion of their cash to buy their own stock off the open market and retire it, they are effectively shrinking the pie.
Right, fewer slices to go around.
Exactly. So if you own a slice of the company, your slice just got inherently more valuable without you having to do a single thing.
It is one of the most direct ways a company can manufacture value for its existing investors.
And it doesn't stop there. They also announced a 12% increase in the quarterly common stock dividend beginning in Q3 2026.
So more cash straight to shareholders.
Their overall payout ratio is sitting at 92%. And while they are throwing off all this cash to investors, their efficiency ratio actually improved by roughly 530 basis points year over year.
Dropping down to about 57%, yeah.
Which proves positive operating leverage. Finally, their CET1 capital ratio remains highly secure at 12.8%. So for you, the listener, the translation here is that Citi is essentially throwing a massive payout party for its investors while simultaneously operating more cheaply and efficiently than it did a year ago.
We really need to contextualize how rare and powerful that combination of massive payouts and high security actually is.
Yeah, let's talk about that safety net.
Let's look at that CET1 ratio you mentioned. Common Equity Tier 1 is a strict regulatory metric that measures a bank's core equity capital against its total risk-weighted assets.
Okay, so it's a stress test.
It is essentially the ultimate stress test measure of a bank's financial strength and its ability to withstand an unexpected economic crisis. Citi's CET1 is sitting very strong at 12.8%.
In other words, by government standards, they have plenty of safety cushion.
Plenty. They are roughly 120 basis points above their stringent regulatory requirement.
Oh, wow.
Now combine that impenetrable safety cushion with a $30 billion buyback and a 12% dividend hike.
It's a huge flex.
It is a flex. By holding capital ratios that strong while authorizing that immense level of payout, Citi's management is signaling absolute, unwavering confidence in their restructured business model.
Right.
They are basically telling Wall Street, we have hit our stride, our efficiency is vastly improved, the restructuring is behind us, and we are supremely confident in hitting our medium-term target of a 14 to 15% return on tangible common equity.
They're proving the critics wrong.
They are demanding the market recognize this isn't a fluke. This is their new baseline of profitability.
Okay, let's wrap this up and pull out the core aha moments for you. Citi's absolute decade-best quarter wasn't magic.
No, it wasn't.
It wasn't just macroeconomic luck. It was driven by the unsung hero of corporate plumbing, that massive services division acting like an 18-wheeler, moving billions across the globe with sticky software and huge margins.
Yep, the plumbing is highly profitable.
It was driven by the flashy sports car wins in investment banking and equities. And it was driven by a ruthless focus on shedding legacy weight, like foreign retail branches, to focus on managing the wealth of the ultra-rich.
A total strategic overhaul.
Exactly.
Yeah.
And all of this combined acted as this incredibly powerful, multi-billion-dollar shield against the rising tide of everyday consumer credit card losses.
It really highlights why looking past the headline number is so critical to understanding the actual economy.
So true.
Because the glossy headline just says, global bank makes billions, but the underlying data tells a much more complex story.
Which is what?
That global corporate trade is booming, but the everyday consumer is stretched dangerously thin.
Why should you care about this?
Well,
Because the next time you hear a news headline about massive bank profits, you are going to know exactly what is happening behind the curtain.
you'll see the full picture.
You'll know that corporate global engines are booming and moving capital seamlessly, while the everyday consumer swiping their credit card at the grocery store is quietly feeling the pinch. And the bank is sitting comfortably in the middle, managing the spread between those two realities with a $22 billion fortress protecting them.
It gives you a much more nuanced, granular view of the opposing economic realities we are living in right now.
Which leaves us with a pretty heavy question to end on.
Oh, absolutely.
A lingering thought for you to mull over as you go about your day. If Citi's massive corporate services are absolutely booming, but everyday consumer credit defaults are quietly, steadily ticking up, what happens when those two opposing economic forces finally collide in the broader economy?
That's the big unknown.
Will the massive corporate shield hold forever, or will the harsh reality of the consumer eventually drag down those high-flying corporate numbers?
That is the exact tension every economist will be watching closely in the quarters to come.
Thank you for joining us on this deep dive. We'll catch you next time.